Hi, I'm Christine Benz for Morningstar. One of the most notable aspects of the tax legislation signed into law earlier this year is an increase in how much of your state and local taxes you'll be able to deduct. Joining me to discuss that change and what we all need to know about it is tax and retirement expert Ed Slott. Ed, it's always great to see you.
Thanks, Christine. Great to be back with you.
It's great to have you here. I want to discuss this elevated SALT tax cap, which is changing in 2025. We can deduct more of those state and local taxes. Can you talk about what's changing? It seems like it's much more generous than that 10,000 cap we had in the past.
Yes, it's one of the biggest benefits in the new ABBA law, One Big Beautiful Bill Act. And this is one that's temporary, but it starts this year. In other words, you can take advantage of it for 2025 through 2029. So it's temporary, but we have a few years of this. And before this, if you recall, if we go back in history, the Tax Cuts and Jobs Act cut out state and local taxes, the deductions, SALT, state and local tax deductions, and put a cap of 10,000. Well, what happened, according to IRS after that, more than 90% of taxpayers ended up taking the standard deduction, because that was the big deduction. The income and property taxes that people were paying that got them, qualified them, got them into the club to itemize. So they couldn't itemize. That was the big item. Now this has been enhanced, greatly enhanced, by 30,000. So the new limit is 40,000, the 10 plus the 30,000 increase to 40,000. And like everything else in the ABBA law, it has income thresholds, but this one is a wide net, brings in a lot of people. It's $500,000. But there's always a catch with these things where they try and get some little bits of revenue out of it that you won't see. There's a marriage tax in this one, or a marriage penalty, you might call it. These are the same numbers I gave you, the 40,000 with the 500,000 income threshold. In other words, under 500,000 of adjusted gross income, you qualify for the full 40,000. It's the same whether you file married joint or two single people. So two single people could each take 40,000. One married couple can only take 40,000. Two single people can each have up to 500,000 of income. Married couple can only have up to 500,000 of income. But granted, it's a pretty big number. So that will help people get into itemized deductions for this year, for 2025. That opens up opportunities to load up charitable contributions, your home mortgage interest, medical expenses. If those are over that threshold, that has a 7.5% threshold over AGI. But that could really reduce your taxes this year if you have big state and local tax deductions. Now, I was doing a program and talking about this in Florida, and I started talking about this. They said it was a lot of retirees. They said, who cares? We don't pay state taxes. And their property taxes were nil. So I said, well, maybe it doesn't apply to you. But then the next week I was in Texas, and I stopped myself. I said, this probably doesn't apply to you. But a lot of the people I was talking to had big properties, and they said their property taxes are a fortune. There's no state taxes, but this could really help people that have large property taxes. And the states that have high taxes, like mine, New York, New Jersey, California, all of those states, well, you get a double bang. You get the property taxes and the state income taxes. And in some states like, Illinois, you have Chicago, you have New York City taxes. You get state and city taxes. So you can really take a big deduction there.
Well, that's what I wanted to ask, Ed. The main types of taxes that fall under this SALT umbrella would be property taxes, as you said, my state income taxes. What else should I be careful to have documentation about if I wanted to include these?
Those are the main ones. The state, okay. Yeah, those are the biggest items. Those are by far the biggest items. There may be fees and other things, certain local things maybe, but it's basically your property taxes and your state income taxes.
Okay, so you mentioned that income level at which this potential deduction starts to phase out, and then if you're over 600,000, I think is the number, yes, then you're stuck with the 10,000 cap. So can you talk about that and also talk about steps that for people who are in this general zone, what could they consider to potentially get themselves under, ideally, that $500,000 level, but at least to be able to take a piece of this new higher deduction?
Right. The phase out is a big phase out. In other words, that's another way they get some of that benefit back. It phases out quickly over 100,000 from 500 to 600. It phases out 30 cents on the dollar, 30%. So once you hit 100,000 over the 500,000, you hit the 600,000, you lose the 30,000 benefit. But because you lose that in that gap, if you do the math, it's an effective 45.5% tax in that bubble, in that 100,000 between 500 and 600. So most people, I think, will be under 500 of income. But if they're not, and let's say they were thinking about Roth conversions, that's one where I might concede the Roth conversion, cut back on that, because this is too big of a deduction, because it gets you into the group to get other deductions. It has a ripple effect, opening up itemized deductions. So I would do all I can to keep income low, if you can, to stay under 500,000 if you're close. If you're well over the 600,000, you're not going to get it. But there's one little break, not well known, but there's something called the pass-through entity tax. I don't know if you've heard of this, but it affects small businesses, pass-through businesses, partnerships, LLCs, taxless partnership, S-corps, where they have small businesses and they have pass-through income that goes onto the return of the owners of the businesses, like an accountant, attorney, a doctor. They have pass-through income. So what happened after they lost their big state tax deductions that was capped at 10,000, states wanted still to help them because they wanted people to stay in the states and keep paying the taxes. And they created something called pass-through entity tax, where in its simplistic form, I'm making this quick, as quick as I can, you could deduct your on your business tax return, you could pay your state income taxes related to the business out of the business and deduct it right off the business pass-through income. Well, that's fantastic, because that could get you way over the 40,000. Let's say you have a business owner, he makes a lot of money, $1 million pass-through income. He pays 100,000 in state taxes. He can take that off. And now his pass-through income, he could write the check out of the business, and his pass-through income is only $900,000. Now that is an above-the-line deduction. That reduces AGI. That saves the 15.3% self-employment tax. It saves, if it applies, the 3.8% net investment income tax. So that's a big saver. What happened is this was created, and IRS approved this after the Tax Cuts and Jobs Act. A lot of states wanted to have this done. They talked to their politicians and lobbied for it. And the IRS approved this with a ruling back in 2020, but still people were leery about it. What happened in the ABBA law, the last version of the law, the Senate version of the bill that became law, is the one that became law. But the version before that, the House bill, had a line in there saying everything I just said, the PTET, the pass-through entity tax, is disallowed. When the Senate bill came out, that line was mysteriously removed. I guess a lot of senators have small businesses or whatever. And so it's not in there. So now people are saying that, yes, you can do that now, because they took that line out purposely. So you have to look at your state. Each state has different qualifications, and this is only for the people that want to deduct a lot more than that because their taxes are a lot more. So it's just a workaround that's legal now.
Okay, Ed, this has been really helpful. It sounds like this is an important new deduction for a lot of households. Thank you so much for being here with us to discuss it.
Thanks, Christine.
Thanks for watching. I'm Christine Benz for Morningstar.